Welcome back. You're watching Traders Corner, and joining me to delve into what the charts are suggesting is Garth McKenzie, editor and founder of Traders Corner. Garth, thanks so much for your time today.
Thanks. Hi, Bronwyn.
So we've seen the S&P rally a little bit, and this has almost kind of wiped out all the bad news of December that we saw. So what is the chart telling you this week? Are we going to see it rally higher, or are we in for a pullback?
Well, it's interesting. I'm going to look at the weekly chart of the S&P 500 quickly, just to reiterate what I've been saying about this, and the fact that you can see we broke below that major upward trend in late sort of October last year, which is quite a significant technical development. And we saw that very aggressive sort of 20% sell-off into the end of December. Now, the market has rallied very nicely off those lows. It's up about 13% off the lows. But it is still running up towards an area of resistance. And I've gone on repeatedly about this 50-week moving average, which is now pointing slightly downwards. And in the past, that has always indicated a bearish market environment. So for now, I still think this is generally an oversold bounce within a newish, potentially a new bear market. And I won't be surprised if we bounce and then see another leg to the downside. So that's the weekly chart. If we just fast forward a little bit to the daily chart and zoom in a bit more on the recent trading activity, here you can see the downtrend that goes from those October highs of last year. And it comes in at around about 26.75, where that downtrend is. And then above that, we've got the underside of the 200-day moving average, which is at 27.40. So if we were to perk up a little bit from here, push a bit higher, but then reverse down, I suspect still that we could see another leg to the downside in this market. Not necessarily to go and revisit those lows that we saw in December. I don't know about that. But certainly to retrace some of these big gains that we've seen over the last couple of weeks. So I'm cautious, but I think in the very near term, there may still be a little bit more upside. I think what we've got to also watch out for now is how the talks with China and the US resolve in terms of the trade war. And if there's some positive development there, which we don't know at this stage, but if there is, that actually might be a catalyst that pushes this market a little bit higher. And then once that's out the way, I suspect then the market may be looking for the next thing, and it might start to once again focus on earnings, which so far have not been phenomenal.
On the China trade, we're going to have to watch this week very closely as those meetings take place in Washington. But then coming back home, the top 40 future, not really giving us much excitement. We seem to just be bumbling along at that 48,000 level.
That's right. It's been extremely dull over the last 2 weeks, really. And if we look at the top 40, you can see the trading activity there. I mean, these are the daily candles on the top 40 future that I'm pointing out here now. You can see from the 11th of January, it's really been hugging this 48,000 area. And we've had no real progress in either direction, and tries to make a break to the upside, doesn't seem to get going, starts to look as if it might be rolling over, doesn't get going. It just seems to be hugging that 48,000 area quite tightly. So we'll need to see once it decides to move off there which direction it moves into. 49,000 is a big area of overhead resistance, which we'll need to watch out for. If it does, however, start to turn to the downside, then there are some gaps in the chart lower down. There's a gap at about 46,600, which could potentially be targeted if we do see this starting to roll over. So it's a bit of a 50-50 at this point in time as to whether it's going to move higher or lower from here.
So we're in a holding pattern on the local front for now, but we're going to start off the new year. It's our first trades for 2019 that we're going to get into. You've got one local and one offshore. So our local one today is ABSA, and it comes on a day where Maria Ramos, the CEO, is retiring. So what are you seeing there?
Yes, and that's part of the reason for the trade. So what we've got here is the daily chart of ABSA here. And what I've put on is Bollinger Bands, which we don't actually look at very much on the show. In fact, I don't often look at them generally in my analysis, but occasionally they do throw up something interesting. And what's often interesting is when you get a push to the upper Bollinger Band or a lower Bollinger Band, as the case might be, and then you get a very clear reversal off that band. And that's what happened yesterday. You can see quite clearly a very big bearish reversal pattern off the upper Bollinger Band on ABSA yesterday. And then what happened this morning is we come in and we get this announcement that Maria Ramos has decided to retire as CEO. And the share price was up 3% on the back of that news. So that in itself tells you something, I guess, in terms of what the investment community thinks. But nevertheless, my thinking is that that's probably a little bit of an overreaction, a bit of a knee-jerk reaction. broadly speaking, I still think that the stock has probably run a bit too far, a bit too quickly, and it probably needs to start to consolidate from these levels. So with it being up at 180 odd rand this morning, or just above that sort of level, I took that as a cue to actually go short of the stock. We're looking for it, to unwind that little bit of knee-jerk reaction that we saw to Maria Ramos's retirement. And then secondly, just purely on the technicals, the fact that I think it looks quite stretched at the moment, and it does look as if it probably needs to consolidate a little bit. So with all of that in mind, I did go short at 180 rand and 78 cents. My stop loss is at 185, so it's far enough away, I think, that we hopefully won't see that stop loss being flirted with. And then I would look for a move back down towards this zone of support where the dotted line is on that chart. Around about 165 to 170, that sort of region is where I think it could potentially pull back to. So that's the trade that we've done, and that gives us fairly nice parameters in terms of a possible risk to reward ratio set up as well.
Okay, so then let's take a look at the mechanics of that trade.
Right, so we shorted 180 rand and 78 cents. My stop loss is at 185. Risk per share is 4 rand and 22 cents, therefore. I'm risking 1.5% of our account. So now remember, we've started the year with 150,000 rand in our local account. So 1.5% of that amount is 2,250 rand. That's what we're willing to lose in the event that I'm wrong on this trade. So to calculate our position size, we take that capital risk of 2,250 rand and we divide it by 4 rand 22, which is the risk per share. And it gives us a number of 533 shares. We're trading CFDs here, so effectively 1-for-1 is your conversion ratio. So we're shorting 533 CFDs for the portfolio this week. As I said, my target region is 165 to 170, somewhere down there. And that means that our risk to reward ratio, it varies between 1 to 2.5 at the lowest end, up to 1 to 3.7 at the upper end. So remember, we set out on the show at the beginning of the year to have a goal to try and ensure that our winners are 3 times bigger than our losing trades. So it fits the bill in the sense that the risk to reward ratio is somewhere around about that 3 to 1 sort of area.
Okay, then offshore, you're looking at General Motors, and it's something a little bit different that you're doing with that trade. You're going to initiate put options rather. So first, walk us through why you're seeing opportunity in General Motors, and then maybe also just give us insight into why put options specifically.
Right, yeah. So here's the chart of General Motors listed in New York. So obviously, if you're going to trade this stock, you need to do it on an offshore platform. We do have an offshore platform at our disposal. We've got $15,000 that we've put into an offshore portfolio for this year. Now, what gets me interested about this stock, and I do watch it fairly closely, is that there have been a number of occasions over the last year where the share gaps up for a variety of reasons, usually, or always because of some sort of news event. And you can see the gaps highlighted on the chart over there now. So the first gap that we had was at the end of May last year, and that was when SoftBank, the big Japanese private equity business, invested $2.25 billion into General Motors' autonomous driving vehicle unit. And you saw the price gapping up quite significantly on that news. And it continued up for a little bit, but then it eventually gave it all back. And the gap got closed, and the share price actually moved quite a lot lower subsequently to that. Then at the end of October last year, the company came out with an earnings beat, and that market took that well. The share price gapped up, but again, that good news was very quickly digested and the share price retraced and it closed the gap. Now, what's happened earlier this month is that the company once again came out with a bit of an earnings beat and a positive outlook, and the share price gapped higher, and it has continued to climb a little bit, but I get the feeling now that it's exactly like what we've seen in the past, where the good news has now been factored in. The upward momentum is beginning to wane a little bit, and the likelihood is that we will see the price retracing over the next couple of weeks, maybe a couple of months, to refill that gap, which sits at about $35 per share on General Motors. So the way I'm looking to trade this is with a put option. A put option essentially is if you're buying a put option, it gives you the option to sell an asset at a price at a future date. That's the simple definition, but these things are tradable. So what I've done is I've gone long 5 put options with a strike price of $35. They expire on the 18th of April, so we're talking 3 months' time here. Quite a long way out in terms of time value of money. And the price that I've paid there is 59 cents per option. Now, every option effectively converts into 100 shares. So the fact that I've done 5 options implies that I've bought 500 shares, or put options on 500 shares, essentially with a strike price of $35. And of course, I've paid 59 cents for each of those, multiplied by 500 to get my premium. So let's just unpack it a little bit more in terms of the payoff of a put option, just so that people can see how it works. Now, along the bottom axis on the graph over here, I've got all the different share price ranges of General Motors. And then on the left-hand side, I've got the profit. Basically, above the thick black line there is profit, below is loss. Now, when you buy a put option, this is your typical payoff profile for a put option. You pay away your premium, which is essentially what I've done there. So above $35 per share, I'm paying away the premium. Remember, I paid 59 cents per share, and I've done effectively 500 shares worth. So what that means is I've paid $295 for this, right? Below $35 per share, the put option will begin to start working, in essence. And that then continues to make money, the further the share price falls. Yeah. Now, in this case, I'm not looking to hold this option out to expiry. I'm not looking to hold it until the 18th of April when it expires. These options are tradable in between now and the expiry date. So what I'm looking at really is a more immediate payoff profile, which would look something like that green line on that chart over there. And what you'll find is that over time, as we approach the 18th of April expiry date for this option, so that green line would tend more and more and more towards the red line. The thinking, however, is that if General Motors share price were to pull back, in the next, let's say within the next month sometime, then that 59 cents premium that I've paid for those options could quite easily increase in value quite significantly. You could quite easily see that 59 cents possibly doubling in value if we see General Motors pulling back and closing that gap in the chart over the next month or so. So that's what I would be looking at here. I'm certainly not going to be looking to hold these options out until expiry and hoping that it ends in the money. The idea is that if the share price falls in the near to medium term, then I would see these options improving in value, and then I'll take profit on the option and sell it and make some money out of it. Worst case scenario here is that I lose my $295 premium, which is 2% of our offshore capital. So it's not a big amount that we're risking here. But yeah, I mean, in terms of what I'm expecting to happen and why I've done this trade, is that I'm looking for that share price ultimately to retrace some of these recent gains and ultimately go and fill that gap down at $35. And the sooner that happens, the better for me, because that'll mean that our options then improve in value quite dramatically. We can sell it out and make a bit of money.
Okay, so with those two trades locked in, let's take a look at the portfolios and see where we're standing.
All right, so our South African portfolio, we're just sitting with a short position in ABSA that we discussed. When I put these slides together, the share was in profit. We were up 803 Rand on a mark-to-market basis at that stage. So we're slightly up for the year to date. Very early days, though.
Nice way to start, though.
It is nice. Let's hope that it continues in that direction. I've always liked my cricketing analogies, and this is me trying to get off the mark, as it were. And then in our offshore portfolio, we've got these put options on General Motors, which I've discussed, which are, at this point, they're priced pretty much the same value as what I bought them at. So we will update that value each week on the show to show the viewers how that valuation is changing.
Garth, then just very quickly, you do have a few courses coming up, so where can viewers go to get more information?
Yes, we've got courses coming up in Joburg, Cape Town and Durban in the next few weeks. Anyone that's interested in attending any of these courses, please email me, garth@traderscorner.co.za, and I'll email you all the information.
Garth, thanks so much for your time today.
Thanks.
Garth McKenzie is editor and founder of Traders Corner.